This is the moment most people don't realize they're already living through. Life in America is about to change in ways no one is ready for, including you, and the data is screaming it. Not in headlines, not on cable news, but in the numbers most people never look at. Since 2020, the average American household has lost between 20% and 30% of its real purchasing power, depending on location. Household debt just hit record highs, credit card interest rates are sitting above 20%, and more than 60% of Americans now live paycheck to paycheck, even as the economy is supposedly strong. Home ownership affordability is near the worst level in modern history. Job security is quietly eroding, and the cost of simply maintaining a normal life, housing, insurance, healthcare, transportation, is rising faster than wages almost everywhere in the country. This isn't a recession warning. This is a system-level shift already underway. And the uncomfortable truth is that most people won't realize how much has changed until the old rules they're still playing by stop working altogether. The two-income era is over now. It's the three-income survival model. You can feel it, even if you haven't put numbers to it yet. One job doesn't cut it. Two jobs barely stabilize the ship. And increasingly, what used to be called side income is no longer optional, it's structural. The Bureau of Labor Statistics shows that the number of Americans working multiple jobs has climbed back near multi-decade highs, hovering around 8 to 9% officially. But that number massively understates reality because it doesn't fully capture gig app stacking, freelance contracts, online selling, or part-time remote consulting layered on top of full-time employment. Private surveys now suggest that well over 60% of working Americans earn money from at least one secondary source. And here's the key shift. This isn't extra money for vacations anymore. This is rent money, grocery money, insurance money. Since 2020, cumulative inflation has eaten away more than 20% of purchasing power using official CPI. But if you isolate essentials, food, insurance, utilities, housing, the effective inflation for middle-class households has been closer to 30 to 35% in many regions. Meanwhile, real wage growth has been inconsistent, and when adjusted for cost of living, many households are still underwater compared to pre-2020 purchasing power. So what happens? You drive Uber after your 9 to 5. You flip items online. You trade options. You monetize hobbies. Not because you're building wealth, but because your fixed costs don't negotiate. And the psychological shift is permanent. More than half of Gen Z and millennials say they expect to always need at least two income streams. Think about that. An entire generation that does not believe one job will ever be enough. That's not a temporary recession mindset. That's a structural change in how Americans survive. And when survival requires constant monetization of your time, your hobbies, your weekends, that changes life in ways no one prepared you for. Here's something that doesn't get enough attention. The gap isn't just widening, it's calcifying. We are moving into an economy where the top tier compounds and the bottom tier stabilizes at survival. Federal Reserve data shows the top 10% of households now control roughly 70% of total U.S. wealth. The bottom 50%? Around 2 to 3%. Asset inflation over the past decade, stocks, real estate, private equity disproportionately benefited those who already owned assets. The S&P 500 more than doubled between 2013 and 2023. Home prices nationally rose over 40% between 2020 and 2024 alone in many metro areas. If you owned assets, you accelerated. If you were renting and paycheck to paycheck, you absorbed rising costs without the appreciation offset. That's the K-shape. But what's new is that mobility between those tiers is slowing. Mortgage rates hovering in the 6 to 7% range have locked millions out of home ownership. Only about 1 in 4 households can currently afford the median-priced home using traditional lending standards. Student loan balances have resumed repayment pressures. Credit card interest rates are averaging above 20%, the highest in modern history. So, upward mobility now requires either capital or exceptional income growth, both of which are statistically rare. And this is where life quietly changes, because when mobility freezes, behavior shifts. Risk tolerance drops, family formation delays, birth rates decline. Entrepreneurship slows because failure is unaffordable. People cling to stability rather than pursue growth. And when an economy shifts from expansion psychology to preservation psychology, innovation and optimism decline with it. That affects everything from housing demand to consumer confidence to political stability. This isn't just inequality, it's structural stratification. And once that becomes embedded, reversing it takes decades, not election cycles. The cost of stability is rising faster than the cost of luxury. Something subtle but powerful is happening. Essentials are inflating faster than discretionary goods. You might notice TVS are cheaper. Streaming services compete. Electronics get discounted. But try insuring a home in Florida. Try renewing auto insurance in California. Try paying health insurance premiums without employer subsidies. Since 2019, average homeowners' insurance premiums have surged by 30 to 50% nationally, with some states seeing increases above 100%. Auto insurance has jumped double digits year over year. Health insurance deductibles continue to rise even when premiums stabilize. Property taxes adjust upward with home valuations. Utility costs spike with energy volatility. These aren't optional expenses. They're the price of stability. And here's where it becomes dangerous. When fixed costs rise faster than wages, households lose flexibility. According to recent consumer expenditure data, housing, healthcare, and transportation now consume well over 60% of the average household budget. That leaves less margin for savings, investing, or emergency buffers. And remember, nearly 40% of Americans report they would struggle to cover a $400 emergency expense without borrowing. So what happens when stability itself becomes expensive? People delay maintenance. They underinsure. They skip medical visits. They refinance risk into credit. And then one shock job loss, illness, accident cascades into long-term financial damage. This is how middle-class erosion happens quietly. Not through dramatic collapse, but through rising baseline costs that slowly compress optionality. Life changes not because of one catastrophic event, but because maintaining normal life requires more effort, more income, and more leverage than it did 5 years ago. And if that trajectory continues, stability becomes a luxury. A lot of people keep hearing that the job market is strong, and on the surface that sounds reassuring. Low headline unemployment, jobs still being added. Everything looks fine, right? But when you actually zoom in, what's happening underneath tells a very different story. One that's changing how life in America works in ways most people aren't ready for. The jobs being added are increasingly concentrated in lower-paying service sectors, healthcare support roles, and government-funded positions, while higher-paying white-collar roles are being quietly cut, frozen, or replaced through automation and restructuring. Layoffs in tech, finance, media, and professional services haven't stopped. They've just stopped making headlines. And here's the part most people miss. Hiring has slowed dramatically relative to population growth. That means competition for good jobs is getting fiercer, even if the unemployment rate doesn't spike. On top of that, job tenure is shrinking. Companies are optimizing for flexibility, not loyalty. Contract work, temp roles, and probationary employment are replacing long-term stability. According to recent labor data, the average duration of job postings has increased, meaning companies are slower to hire, more selective, and often fishing for perfect candidates while offloading work onto existing employees. And if you're over 40 or highly specialized or making above the median wage, you're feeling this already. Finding a comparable replacement job after a layoff now takes significantly longer than it did even 5 years ago. That's why emergency savings are being drained and credit is being leaned on. Life changes when job loss goes from being a temporary setback to a prolonged financial event. People stop taking risks. They delay moves. They stay in bad jobs out of fear. And when an economy quietly teaches its workforce that replacement is easy and security is temporary, behavior shifts across the board. This isn't just a job market problem, it's a psychological reset. Credit used to be a bridge. You'd use it temporarily, pay it down, and move on. Today, For a growing number of Americans, credit has become structural not because people are reckless, but because income no longer covers baseline expenses consistently. Credit card balances recently crossed $1.1 trillion, an all-time high. Delinquencies are rising fastest among middle-income households, not the poorest. That's important. It means people who used to be fine are now relying on credit to smooth basic cash flow. And the cost of that credit has exploded. Average credit card interest rates above 20% mean balances compound aggressively, even when people are making minimum payments. By now, pay-later loans once marketed as harmless convenience are now being used for groceries, utilities, and medical expenses. Missed payments are starting to show up on credit reports, and when credit scores fall, everything gets more expensive. Insurance premiums, loan rates, even rental approvals. It's a feedback loop. Lower scores increase costs, which increases reliance on credit, which further damages scores. This is how people get locked out of opportunity without realizing it's happening. And here's the part that changes life in a very real way. Once credit becomes survival infrastructure instead of leverage, people lose flexibility. You can't relocate easily. You can't absorb shocks. You can't invest. You're managing payments instead of building options. And because credit reporting lags reality, many households feel fine until suddenly they're not until a rejection, a rate hike, or a missed payment cascades. This isn't about irresponsibility. It's about a system where rising costs and stagnant real incomes quietly turn financial tools into financial landmines. And when millions of people are walking that tightrope at the same time, life in America doesn't just get harder, it gets more fragile. Artificial intelligence isn't just changing jobs. It's changing income stability. There's a conversation happening about AI that's far too simplistic. People are debating whether it will take jobs or create jobs, but that framing misses the real shift. The real change is in income volatility and bargaining power. Artificial intelligence is accelerating productivity in ways we haven't seen since the early internet era. But productivity gains don't automatically translate into wage gains, especially not in the short term. According to IMF and OECD projections, up to 40% of global jobs are exposed to AI-driven automation to some degree. In the US, white-collar, knowledge-based roles, the ones once considered insulated, are now directly in the crosshairs. Legal drafting, financial analysis, content production, coding assistance, marketing strategy tasks that used to justify six-figure salaries are now being partially automated or augmented. And here's what that means for you. Even if you don't lose your job, your leverage declines. When employers know productivity can be supplemented with automation, raises become harder to justify. Teams get leaner. Expectations increase. One employee is now expected to do the output of 2 or 3 from just 5 years ago. That creates burnout and suppresses wage growth simultaneously. Meanwhile, high-skill AI developers and infrastructure owners capture outsized gains, reinforcing the K-shaped divide we already talked about. And the scariest part? This shift doesn't require a recession to unfold. It's happening quietly during periods of economic expansion. So life changes not because unemployment spikes overnight, but because stability erodes incrementally. Career paths shorten, industries pivot faster, skills become obsolete quicker. Long-term planning becomes harder when the half-life of expertise shrinks. That uncertainty changes how people save, how they spend, when they retire, and whether they feel confident making major life decisions. AI isn't just a tech story. It's a structural economic shift that compresses security timelines. The housing market isn't crashing. It's freezing, and that might be worse. For years, people have been waiting for a housing crash. Prices too high, rates too high. Something has to give, right? But instead of collapsing, the market has locked up. And that freeze is quietly reshaping American life in a more permanent way. Mortgage rates hovering around 6 to 7% have created a phenomenon economists call the lock-in effect. Millions of homeowners refinanced at 2 to 3% between 2020 and 2021. Those people are not selling unless absolutely forced to. That chokes inventory. Meanwhile, new buyers face affordability levels not seen in decades. The median home price relative to median income remains near historic extremes. Monthly mortgage payments on a typical home have nearly doubled compared to pre-2020 levels when you factor in both price appreciation and rate increases. So what happens? Younger households delay ownership. Families stay in starter homes longer. Mobility declines because people won't give up low-rate mortgages to move for new job opportunities. Rental demand increases, pushing rents higher in many markets despite broader economic softness. Builders slow construction because demand at current price points weakens, which further limits supply. It becomes a self-reinforcing freeze. And housing isn't just about shelter, it's the primary wealth-building vehicle for the American middle class. When entry into that system gets delayed by 5 or 10 years, lifetime wealth trajectories shift dramatically. Equity accumulation slows, retirement planning changes, intergenerational wealth transfer patterns alter, and socially, you begin to see ripple effects: later marriages, lower birth rates, more multi-generational households. That's not a cyclical dip, that's structural transformation. Life in America changes when the cornerstone of middle-class stability, homeownership, becomes less accessible and less mobile, not through collapse, but through stagnation. Healthcare is quietly becoming a financial risk event, not a safety net. Most people still think of healthcare as something you deal with when you're sick. But in America right now, healthcare itself has become one of the biggest financial risks you face, even if you're healthy. Premiums, deductibles, co-pays, out-of-network charges, surprise bills, all of it has been rising faster than wages for years, and the pace hasn't slowed. Employer-sponsored health insurance premiums have increased roughly 20 to 25% over the past 5 years, while deductibles have grown even faster. The average deductible for a single worker is now well over $1,700, and for families, it's north of $3,500, and that's before coinsurance kicks in. Translation: even good insurance doesn't protect you from a multi-thousand-dollar hit. And here's where life really starts to change. People delay care. They skip prescriptions. They avoid preventative visits because they don't want to trigger costs they can't predict. Medical debt is now one of the leading causes of collections in the United States, affecting tens of millions of households, including people with insurance. And medical debt doesn't behave like other debt. It hits suddenly. It's emotionally charged, and it often comes at the worst possible moment during illness, injury, or crisis. This is why healthcare costs are now a major driver of bankruptcies, credit score declines, and early retirement decisions. Older workers stay in jobs they hate just for insurance. Younger workers avoid entrepreneurship because losing coverage feels too risky. Families budget not just for rent and food, but for the possibility of getting sick. That's a profound shift. Healthcare was supposed to reduce uncertainty. Instead, it's adding another layer of it. And when something as fundamental as health becomes a financial gamble, it reshapes behavior, priorities, and long-term planning in ways most people never expected to face in a developed economy. The government's financial math is colliding with everyday reality. There's a growing disconnect between what people hear from official narratives and what they feel in their daily lives. And nowhere is that more obvious than in public finances. Federal debt has surged past levels that used to be associated with emergencies, not normal operations. Interest on that debt is now one of the fastest-growing government expenses, rivaling major entitlement programs. And when governments spend more just to service old obligations, something else eventually gives. Sometimes it's benefits, sometimes it's services, sometimes it's taxes, often in subtle ways people don't immediately recognize. Higher payroll taxes, reduced deductions, increased fees, means testing that quietly disqualifies people who thought they were safe. At the same time, programs many Americans assume will be there: Social Security, Medicare, pensions are facing demographic pressure from an aging population and a shrinking worker-to-retiree ratio. Even if benefits aren't cut, changes to eligibility ages, cost of living adjustments, and taxation can significantly reduce real payouts over time. That uncertainty changes behavior today. People save more out of fear, or they give up entirely and disengage. Trust erodes. And when trust erodes, compliance drops, participation drops, and polarization increases. You start seeing people question whether the system works for them at all. That's not just a political issue, it's an economic one. Because systems rely on participation to function. When millions of people feel like they're paying more and getting less, the social contract weakens. Life in America changes when the background assumptions that the government can stabilize downturns, protect retirees, and provide a floor start to feel fragile. You don't notice it all at once. You notice it when planning feels harder, promises feel softer, and the future feels less defined than it used to. The American dream isn't disappearing. It's becoming financially exclusive. If you zoom out and look at everything we just talked about, multiple income streams becoming mandatory, mobility freezing, credit turning predatory, housing locking up, healthcare destabilizing budgets, you start to see something much bigger forming. The American dream isn't vanishing in some dramatic collapse. It's being quietly repriced, and the new price tag is higher than most people can comfortably afford. For decades, the formula felt achievable. Work full-time, buy a home, raise a family, retire with dignity. But now that same formula requires near-perfect execution. You need stable employment with benefits in an era of instability. You need a down payment in a market where prices outpaced wages for years. You need to avoid medical shocks in a system where even insured families can accumulate five-figure bills. You need to manage debt flawlessly while interest rates sit at generational highs. And you need to invest early and consistently in markets that are increasingly dominated by institutional capital and algorithmic trading. According to mobility studies, the probability of children earning more than their parents has fallen dramatically compared to the mid-20th century. It's not impossible, but statistically, it's harder. That's the shift. The dream hasn't died. It's become conditional. Conditional on geography, conditional on education quality, conditional on access to capital, conditional on timing, conditional on not making one major mistake. And most people don't live in a world where mistakes are avoidable. Layoffs happen, illness happens, recessions happen. When upward mobility requires precision instead of persistence, society changes. People delay milestones, they opt out of risk, they redefine success downward. And some begin to question whether the promise they grew up believing in was ever meant for everyone in the first place. That's what makes this so shocking, not that America is collapsing, but that normal life now demands extraordinary financial awareness just to stand still. And if you don't adapt to that reality quickly, you don't just fall behind, you get locked out. So if this video felt uncomfortable, that's probably because it hit a little too close to home. Not because you're doing something wrong, but because the rules changed while most people were still playing the old game. Life in America isn't breaking all at once. It's being reshaped quietly, piece by piece, in ways that don't make headlines, but show up in your bank account, your stress levels, and the choices you feel forced to make. And the hardest part is that nobody really tells you when the shift is happening. You just wake up one day and realize the margin for error is gone. That staying in the same place now requires more effort than getting ahead used to. But awareness still matters. Understanding what's happening doesn't fix everything, but it gives you something most people don't have the ability to adjust before the pressure becomes unbearable. This series isn't about fear. It's about clarity. Because pretending things are normal doesn't protect you. Seeing reality clearly does. And we're not done yet. There are still layers to this that most people aren't talking about, forces that will shape how you work, save, live, and retire in the years ahead. So if you want to understand where this is going before it fully shows up in your life, stay with me. Let me know in the comments what you're feeling the most pressure from right now: housing, work, debt, healthcare, or something else entirely. And if you found this valuable, make sure you're subscribed, because the next part is going to connect dots most people don't even realize exist yet.